Hello, founders. Welcome to Startups.com. We are live, coming to you every Tuesday, Wednesday, Thursday. Here's how it works. Every Tuesday, we do pitch deck reviews. Wednesdays, which is today, we talk all about go-to-market strategies, traction, getting customers, hacking all that good stuff. That's going to be super important because we are talking about go-to-market strategies, specifically the traction investors need to see, because Ryan, who is our co-host today, he is one of the co-founding members of Startups.com and the chief marketing officer. Ryan, the majority of our founders come for raising money. And what happens is, and I'd love to hear your experience with this, founders say, well, I need the funding to get traction, but now you're telling me I need traction to get funding. What's your response when someone says that to you?
Yes, is my answer to that. Yeah, of course you do. And honestly, you want it, right? Before you if we can go get traction without getting money, we want it. We're going to do a couple things. We're going to be more certain about how much money we need. We're going to be driving the valuation up, meaning we're going to be driving the amount of equity that we have to hand over for this down. We're going to be more certain with how we utilize that cash. And the more we can do that, I think people do understand how the valuation changes, right? So if we can drive a little more traction, maybe we can drive a little more valuation. I think one of the things that they miss out on is the more traction we have before raising funds increases the certainty of what we're going to go do with those funds and what we can accomplish with those funds, which not only reduces the valuation this round, reduces the likelihood or the amount we need to raise next round and next round and next round if we should go on to need subsequent rounds, which buys your equity down, the amount of equity that you give away over time down significantly. And I think that this gets lost in all the funding calculus that we do, because we're just need money, don't care about how much equity we have to give up. It's monopoly money now. Will said this once, and it rings in my head every time now, which is that, yeah, it's monopoly money now, but it represents 100% of the future value of your company. Don't ever forget that, right?
Yes.
So every little bit we're trading now is a lot we're trading later.
Absolutely correct. Ryan, I was listening to the CEO of Beehive,
Uh-huh.
and they do hundreds of millions of dollars in revenue. They're growing.
Yep.
And they spent absolutely zero on customer acquisition. And they made a commitment. They said, if we can't release a feature and do things organically with community that increases our traction by 10% week over week, we've done something wrong. It just proves to everyone that you don't necessarily have to doing all the customer acquisition strategies that cost money, buying ads, paying for this, paying for that. There are ways. I'm not saying it works for everybody, but Ryan, I'm sure you've seen many examples of founders looking at getting traction and paying for things and spending money when they could be allocating their resources in other places and getting that almighty organic or engineering something to increase their traction at early stages.
For sure. And look, I'm not anti-paying for traffic, especially early stage. We've talked about this before. If you want to do a long tail SEO strategy and you want to suffer through building organic traffic, great. But before you do that, go buy that same traffic today. Find out if it does what you think it's going to do before you spend 18 months and hundreds of thousands of dollars and tens of thousands of hours building that content. So I'm not anti use money to get answers, but I think it is important to understand that traction of some sort I'm not saying it can't be paid traction. It can be paid traction.
Sure.
It can be organic traction. Can be hustle. Can be bought. I don't really care. I just want to see that so many times founders are well, we just need to build the product first. We need to get the money to build the product. All right, Ed, I'd be curious your take on this, but tech and product aren't a moat anymore.
No, not at all.
I can build stuff that would have taken a dev team weeks to build in minutes now. And I wouldn't consider myself, I'm technically adept, but I'm no longer technical, right? I am not going to go and build something. I have no front end coding capabilities, very little on the database side at this point, but I can build stuff now. So the ability to ship product and needing cash to go build product doesn't add up to something super valuable to me if we're saying, well, we got to go do all that, and then we'll go see if we can build audience. Because if you don't have distribution, I don't care how good your product is. You don't have distribution, you're not selling it. And so then what have we done?
It used to be that back in the day when you just had a .com on your name and you had a website, everyone would go to it. Or if you had an app, everyone automatically want to download it. Product development no longer guarantees distribution. On top of which, investors are getting savvy to this. They know exactly what Ryan described, and they want to understand your go-to-market strategies more than ever before. And that's the reason we're here. We're going to pick Ryan's brain, and we're going to go through a pitch deck. We're going to go through a go-to-market strategy. And going to break down the principles that the rest of you, because I see you in the audience here, and for those of you watching on YouTube, make sure you like, comment, subscribe to the YouTube thing. But I see our members in the audience, and I appreciate Startup.com members joining us. I know that you're in this situation right now where you're trying to raise funding, and I see the allocations to customer acquisition, and it makes me nervous. I'm going to be straight up. But for all of you, if you have a pitch deck, you want it reviewed, and you want your go-to-market strategy sort of investigated, explored, and triaged maybe, or optimized, discussed at least between us.
Or just applauded. Every once in a while, we assume that's just so amazing that all I can do is tip my hat. That's fine too.
Absolutely right. Actually, there are a lot of great go-to-market strategies that I've seen. This is all part of our pitch competition. You can receive a $5,000 advisory and investor relations package. And all you have to do is convince our committee. Ryan's part of the committee. We've got multiple members on there. And it's all based on idea, deck, team, and traction, which is where we are right now. And all you have to do is notify us to apply. Ryan, one of the things that we're going to jump into is the go-to-market strategy. But share with everyone sort of how they engage and interact with you and how you help founders, specifically with go-to-market strategies here at Startups.com.
Sure. So every Monday and Friday, we have the Getting Customers session. That one's been pretty broadly interpreted, and we like it that way. You come in with your challenges. Some people are in there, they're post-product, they're post-revenue. They're trying to figure out how to scale revenue. Some folks are coming at the idea stage saying, like, how do we define our ICP? How do we figure out who we should go after? Other folks are coming in saying, like, look, we need to be able to show meaningful traction so that we can go out and raise funds. We help with that too. So we go around the room, we dig into individual problems. Of course, individual problems are rarely individual problems. They're generally shared by the entire group. And so we dig in and we try to solve stuff. The idea is that from start to finish of that session, we pick out some things that you need help with. And by the end, you walk away with a plan to go and tackle some small piece of that. If we started on Monday, then we're back on Friday to revisit and keep working. So it's a very iterative session, very group focused, and seems to be working quite well.
Remember, everyone, don't just sit around passively. Use a Q&A box, ask us questions in chat, but join Ryan in Getting Customers Workshop. I know many die-hard fans of yours, Ryan, that just show up and all they want to do is hang out with you. And I say, can I help you? And they say, no. And I say, what am I, chopped liver? And they go, yeah. Next to Ryan, you are. So everyone, check out Ryan's workshop. And hey, and you earned it, Ryan. Let's look at this pitch deck. So, Ryan, here's what we're going to do. We're going to go through this pitch deck, and we're going to look at it through problem solution market, right? And I know you know this.
I mean, yeah. I know this product. I know this founder. I have not seen the deck. It did make it over to my desk, but about 15 minutes before the session started, and I glanced at it, but nothing more.
That's
so this will be fun.
That'll work in our favor because I want to hear your reaction. Sure. And then I want to get to the go-to-market strategy because this is one of those situations where, I enjoy spending time with this founder, Aditya, and he's fantastic. And I'm always reminding him, yes, he's doing all the right things when it comes to fundraising. He's really beating the bushes. But I keep reminding him, we got to see that week over week traction growth. And he tells me, I've got some challenges. It's not in season right now. I don't have the funds. I know my customer acquisition costs when it comes to Google. I don't have any more money because I've got a product that's free right now. I'm not monetizing. Therefore, I need to raise investment to, go out there and get that traction. But he's not getting as much attention because people like the idea, but they need to see numbers. And again, I see you in the audience here. I know many of you founders are in this same situation. So Ryan, we're going to take a look at this, and I want to hear what you have to think. Let's bat it around. And once again, those of you in the audience, feel free to throw in your comments. Here's the problem, Ryan. The modern fantasy sports industry loses over 25 million users within weeks of signing up, costing the industry an estimated 500 million annually due to churn from opaque pricing, hidden rules, and luck-based mechanics that erode trust and devalue skill. How's this coming across for you?
There's a lot going on there. I do like the quantifications of it. It's not entirely clear on how those two numbers tie together, right? So is it telling me that the 500 million would tell us that each person spending roughly $20 a year on this? So that's an interesting number to understand as we start to dig into their financials. One of the things I'm going to look for is how do these numbers connect to what we see later on? And I think this is something that a lot of founders sort of take for granted. They're like, I'll put what makes sense on this slide, but then I don't necessarily then I'm telling you, and I'm going to make $300 from every user later. And I'm like, but wait a minute, didn't you tell us earlier that a user's worth $40?
Yeah,
$20 rather.
Yeah,
right.
Yeah.
So there's a lot of things that we'll need to dig into here, but it's okay. I think we could be a little more specific with the problem as it relates. So let's see what the solution is. I want to see how well they tie together. Let's go there next.
I do want to make a comment. Actually, I was the one that surfaced this statistic of fantasy sports losing 25 million users within weeks of signing up. That was staggering to me. So I definitely know that this is a legit pain. I don't know if it creates $500 million in lost revenue, but we'll have to see. Let's keep looking here. The solution: football money is a fair and transparent fantasy football stock market where fans can trade based on real performance and ownership, not odds, algorithms, or luck, turning football knowledge into real financial outcomes.
Okay, jump back to this problem real quick. So I guess we're using some synonyms and stuff here. So if we jump back to solution, I don't see that like real clear reversal that I love to see in terms of like problem and solution where we use a lot of the same language. I think sometimes founders think like we need to say it different. You don't. Like from problem to solution, what we want to see is a reversal of that problem. All right. So one thing we don't see here at all is any quantification of it. All right. So we're not talking about by doing this, we create this much in value, right? Here's the solution. We're really focused now on the solution for fans. We were industry focused on problem slide. We are fan focused on solution slide. So there's a little bit of dissonance there for me. I believe that his actual customers are the fans.
Yeah.
Right. So when we talk about problem, why are we talking about the industry?
Yes. Well, I could see that misconstrued there, but there's definitely about the fans because they do churn. Right.
But it says we have loses 25 million users within weeks. That's not the problem we're solving. We are not solving a problem for the industry because he's just going to be a competitor in the industry. He's going to become part of that industry. The problem he's solving is that fans are leaving individually because opaque pricing, hidden rules, luck-based mechanics, erode trust, and devalue skill. We jump to solution. That the solution is at an individual level. It doesn't solve anything for the industry.
Got it. Okay. So that's how you're
solves it on his platform alone.
Sure. Okay. I did not go down that road, but this is a great example for everyone. Different people are going to interpret your decks differently. So again, the onus is on you to make sure that it's super clear. My question to you, Ryan, is right here from problem solution. Do you understand the gist of what this product actually is?
More or less.
Okay.
Right? It's going to be some sort of a market-based kind of trading app that mirrors some sort of real life football stats.
Yeah, generally, that's in the ballpark. I think this is one of those decks that I think people familiar with the industry will immediately get. But once again, you don't want to take that risk. It's just something for everybody to think about when it's out there.
You want to remember that like the solution isn't the how it works. Like the question you just asked was a bit aligned with like, do I understand kind of what this does?
Yeah.
I don't necessarily need to know what this does. I need to know what it solves for. So I can understand if I believe the opportunity is big enough to be worth my thinking through. If I've got my investor hat on, I go, okay, so they talk about roughly the number of users that are lost for these reasons. They seem to have a solution that will combat some of that. I don't yet understand the individual unit economics of what that does for me as an investor. That's slightly problematic, right? At the problem and solution level, I really want to be able to understand like how big is that problem and how much does my solution solve for that problem so that I understand when we get on to things like market size, how much of this are we reasonably going to be able to tackle?
Sure. Okay. Well, that segues us to the market opportunity. So there are 50 million fantasy sports players in the U.S. We're initially targeting the 10 million highly engaged football fans who can participate in fantasy stock trading or daily gaming platforms. They're using the Will Schroeder method here in terms of, hey, this is a market we're going to grow into. And then just did a TAM, SAM, SOM calculation, and then the upcoming major football events in the U.S. So do we understand who our market is and where we're going to focus initially and why?
More or less. So jump all the way back to problem for me really quick.
Sure.
One of the things that we're talking about, like the overall industry, then we're talking about US, which I get, like when we start talking about the market, it would be nice to see these numbers connected in some way. One of the challenges we have with the way that initial stat was laid out, it doesn't talk about those 25 million in terms of what percentage of the total market that represents.
Sure.
So now when I look at 50 million here, I go, how many of these were those early churns that we're trying to combat?
Yeah, I totally get where you're coming from.
So it makes it a little harder for me to say, here's where I think the soft part of the market, like the early adopter population, the people we're going after, if that's even the case. I think that's the other problem that I have with that particular problem slide is it's talking about people who are churning. Are we actually solving for churn? Or are we making a better experience for everybody? Are we only picking up the people who've dropped out of fantasy sport in the past? Because that's what we're focused on in that problem slide.
Right.
So I think we need to be a little careful there.
Okay, now I just want to point out for all of you out there and those of you who wanting to participate in our pitch competition, this is literally what we'll sit around and do, and we'll bat it around. So I'll bring a pitch deck to Ryan, and I need Ryan's sign off to do this. And if he's like, no, I get it, I think according to Ryan's perspective, expertise, this is going to catch the attention of investors. And that's why we do this exercise, because truthfully, Ryan, I've stared at this pitch deck so much that I can't see the forest for the trees. That's the reason your opinion is so important at this moment in time, right?
Yep. Now, fresh eyes go a long way. Because by the time you've looked at a pitch deck more than 8 or 9 times, for me at least, what I start to see is what I meant, not what I said. Right? Like, well, here's what I was trying to convey. Isn't that clear to everybody else? No, it turns out it's not.
So true. And everybody understand that one of the things that when I was a GP or associate analyst, at these funds, we actually had a marketing expert on staff or someone who had a
Sure.
nose for it. And I asked them, do you really believe in this market? Like, is this a sound go-to-market strategy? So what I'm doing with Ryan right now, this is all one big step, Ryan, because I want you to understand what this founder's trying to communicate and then apply it to, is the go-to-market strategy feasible, or are there other ways that we can help them? Let's continue super quick because I want to get to the meat of this, how it works. I'm not going to really get into it, but the revenue model, this will be important for you, Ryan.
Yep.
It's 1% fee on trades, simple, scalable, transparent, and walk through some unit economics. So kind
Yep.
of like any
I like
app.
that this breaks it down to the unit economics, because sometimes we see the revenue model too closely tied to TAM, SAM, or SOM for me.
Right.
And we're just talking about like, if we get 3% of the market, here's how much money we'll make. How much do you make from one customer? Because we got to start with one. We got to go get one, and then we can go from there. So I like the way this is broken down. It's a fee per transaction model. So then that's likely going to scale. So the assumptions that become really important here for the investor wants to look at this and go, do I believe that people will transact the number of times you're saying they're going to? That'd be one of the very first things that I'm going to look at, right? Like, I don't care how much a transaction's worth unless I believe, one, that people will transact, and two, if you're telling me, they're each person's going to transact 6 times a month. Cool. Okay. Do we believe that? What do you have in traction? Something else that we forget about. This is why traction becomes so important, because traction is the beginnings of proof that any of the rest of this can be possible.
Absolutely correct. Couldn't have said
Takes it out of speculation.
Yep.
Takes it out of speculation and says, okay, you've already shown that you can get people on the platform. You can get them to do trades. Here's how many trades they do a month. Numbers are small, but I don't care. You're demonstrating to me that the model that you're describing at the revenue level, which may not exist yet, is at least replicated at the free level. The behavior is there.
Right. And everybody, pro tip, don't put in potential. This is not a projection slide. You're muddying up the waters. In fact, this is all, I don't understand this. All this was enough. You notice Ryan, all he did was really just focus on this, and that was enough for him to really understand what was going on there. So again, I know you founders, you desperately want to cram your pitch deck and say, no, I've thought this through and we're going to be amazing, but keep it sparse so they understand the questions are going to come out in due diligence, everyone. Don't worry, but let's continue on. Go-to-market strategy.
Stick on that point for just a second. Stick on that point for just a second. We don't have to stick on that slide, but that point exactly around like, but if I tell them this and I tell them that and they believe it, what you have to remember is every new piece of information you're putting on a slide can be a proof point depending on how well it's backed by actual data, not your speculation. You showing them all the things you think will happen isn't particularly helpful. Each and every one of those things you think happens becomes a vector for scrutiny. So if you want to be really scrutinized, throw lots of stuff on the slides and they will beat the crap out of you with it. They will turn it around and use it as a weapon.
Okay. Speaking of beating the crap out of a slide. Okay. So everyone, I've set this up, gotten to this point where we have a marketing expert, chief marketing officer. He's on my committee, everyone. And I'm going to just say, hey, Ryan, what do you think? Is this actually feasible? Take a look at this slide and pow. So Ryan, give it to us straight. Just walk us through what is going through your mind as you read this, so everybody gets the experience of how an investor or an expert, an analyst would look at their go-to-market strategy slide.
Okay, so we got go-to-market strategy, but what we actually see as a project plan, that's one piece of just like general high-level feedback. We'll dig into a little bit more. So look, phasing things out isn't necessarily a bad thing at all, but when we start to attach dates and so forth to it, things like that, then it does start to read a little bit more like a project plan. If there are reasons for that, let's make sure that they're clear. In this case, he does that, right? So it's free access until the end of the 2024-25 season. We're already well into season at this point. That may create some mechanical difficulties within the application. I don't know well enough about how the app works, but he may not be able to dynamically adjust values mid-season, all that kind of stuff. So maybe we have to have kind of a starting point and an end point per season. So based on the mechanics of the platform, that may be a necessity. So I'm seeing some okay stuff here. There's some things that I don't necessarily understand, which we don't want on the slide. Trading and fantasy engaged. What's that mean? Or is this that population of people who started and stopped? They're actively engaged. If these are the actively engaged folks, then again, I'm going to go back to, then why the heck were we talking about people who churned in that first slide? Why is that important? Why is that important? Because remember, what we're trying to do here is tell a story. And whether we're doing a good job of telling a story or not, the investor is trying to understand a story, right? So if parts of the story don't fit together, you're making my job as an investor extremely difficult. And we don't like to do difficult jobs, right? Specifically as investors, we want to not do any jobs. We want to give you our money and then you give us more money, right? I want to not work. So the more work you make me do at this phase, the less likely you are to get my check. So this is an important point because we've now seen some level of dissonance between what we say on that problem slide, on the solution slide, now on the go-to-market strategy slide. We want to be really careful here because this is where that starts to break down and that cohesion in the story starts to become problematic. But let's stick to some feedback just on the go-to-market slide here.
Let me interrupt for a second, just
Sure.
to put out some best practices. Everyone, one of the simplest ways, just like Ryan said, the more information you put in there, the more vulnerable you are to getting scrutinized. A very solid go-to-market strategy, one of the ways to do it is to have, and this Ryan pointed this out right away, it looked like a project plan, not presenting a strategy. So what you do is you have a summary headline sentence explaining the number one channel that you're using, hopefully battle tested, and why. And then you can say, here are the additional channels we tend to hit in the different phases. I do like the phase approach. I typically do this. I have one, we're using influencers because we've been able to, do this campaign at a 30% conversion rate, et cetera. And then the next phase, we're going to move to this, and then we're going to move to that. And just straightforward, simple. And then incorporate any unit economics that you have. So there's an attempt there, but to avoid all this project planning stuff, because Ryan, I want you to comment on this because, for example, this turns into one of these laundry list slides that I always hit. They say, we plan to do all this, this, and this, and you just throw everything against the wall. Yeah. And your hope is somewhere down the line, it's going to stick and investors are going to believe you, but it doesn't pass the test up front right now.
Correct. So one of the things I always try to be a little gentle with when looking at these is this a send ahead deck? Is this something that's going to be presented? Is there narrative that goes along with this? If there's narrative that goes along with this, we got a lot of words on the slide. I can't listen to you and read all this at the same time, and I will absolutely try to do both, and I will fail. So to your point, throwing too much on there is a challenge. One of the things that I don't see here that I find to be extremely important is how and why are we moving phase to phase?
Good point.
All right.
Yep.
Because this just feels very arbitrary. We're just sort of saying we're going to do this at this time, then this at this time, then this at this time. That's not how customer acquisition works. That's not how marketing works. It's how growth works. All right. Growth has to be compounding from something. We don't just switch arbitrarily from one thing to another. We're going to do this. We're going to take away some learnings based on what we learn here. We will either do this, this, or this, right? There's going to be some decision matrix based on what's already happened. We don't see any of that represented here. Now, again, this is where I'm being a little gentle because maybe that's clearly told in the narrative story, the voiceover of this deck. Don't know. Don't have any way to see that, but I don't see any connectivity. The other thing, and this is where I've heard lots of different opinions, and I'd love to hear yours. When I see the go-to-market strategy before the traction, I have a little bit of trouble because I don't know what we've already accomplished that would say any of this is the right idea or possible.
That's a great topic, Ryan. Let me give you a quick response to that. I always include the go-to-market strategy traction on my go-to-market slide.
So that's the other move.
Right? But everyone, and let me go deeper here. Ryan, I want to have this discussion. Because again, I'm looking at all you founders in the audience, and I know a lot of founders in our world that are going to watch this. The best way to create an amazing go-to-market strategy slide is to have already battle tested go-to-market strategies and actually gotten out there, which is what we're talking about. And the other thing, it's so important that if you have that done, you have the numbers and you can start to share that story that we already know what we're doing, what's going on. Now, I understand a lot of times this can't happen, Ryan, that founders don't do that, but there are ways to put a story out there in the early stages in a way that shows investors that you're confident and shows that you're thoughtful versus put a laundry list of stuff there that I really don't believe that you're an expert or you can pull off, AI ads and, SEO and influencer campaigns and everything, even though you may think it's a good idea. Ryan, for you, if it was a founder that couldn't spend all this time battle testing, what are some things that you would put in a go-to-market strategy so you avoid this trap of just throwing it out there and kind of looking like you're a pie in the sky type GTM going on?
So I'm going to answer this slightly differently than what I think you're expecting, which is I might decide I'm not ready to go raise funds yet if I haven't done anything to battle test any of my go-to-market strategy. Like, this is exactly what we're talking about.
Right.
If I haven't done that, if I don't have anything I can put on that slide that says we have any semblance of what we're about to go and do, I might not want to be doing this now. I might want to be back figuring out ways to battle test some of those strategies, right? To the point we made before around that traction buys down the valuation. It doesn't just buy down the equity cost. It doesn't just bump the valuation up. It makes it possible, right? I think that one of the things that we forget is that traction is a huge piece of what makes funding possible. It is a huge piece of what we'll get. Now, look, if I don't believe in your problem and I don't think that your solution will work, but you show me traction that completely contradicts my perspective, I have to kind of go, oh, okay, right? Yeah, okay.
Yeah.
But even if I believe in your problem and I think your solution is adequate, but there's no traction behind it. One of the things that we used to talk about, and I remember Elliot and I had a really great discussion on this years ago, where a lot of this thinking came from, was around this notion that you can sort of divide an investment from an investor perspective. I can put it on a spectrum where there's two ends of the spectrum, like most spectrums, Ryan. On one end, we've got capacity, and on one end, we've got demand.
Okay.
If you've got a lot of traction, you move closer and closer to capacity because you're telling me, we know we can do this. We did this. We've got this. Here's our customer acquisition cost. I can add money to a system that I know is going to create more money in the system, right?
Exactly.
More outcomes, proven outcomes.
Pour gasoline on the fire.
Exactly. If we don't have any traction, you're asking me to make a purely demand-based decision, which is we're going to go out and use money to try to prove demand and get traction. Risk at this end of the spectrum, at the demand end of the spectrum, extremely high.
Huge.
Risk at the capacity end of the spectrum, extremely low. Now, we're usually somewhere in there, but we want to be as close to capacity as we can. And if I haven't gone out and done anything in the market, if I haven't have anything battle tested on the go-to-market side, I am asking investors to take a huge flyer on my ability to do that.
Ryan, let me double click on what you said. I looked at a pitch deck, and right there, I was doing a review on it, and it said, we are Turing plus deal. Right. It just made a statement. I was like, the Turing, isn't that like an AI test? Like, I didn't know. I know what deal is. I didn't know. But then they had a traction slide further up in the deck, typically, in advance to where I'm used to seeing it. And it had a growth graph. And the last month they did $245,000 in revenue.
There you go.
And I
stopped. So basically what they're saying is, we know you don't understand what the hell we said on our first two slides. So let us just show you that regardless of whether you understand it, it's working, right?
It
trumps everything.
Yeah, because I had to stop and go, wait a second. I may not understand, but clearly they're doing something right. Yeah. It made me look at the pitch deck completely different.
100%. It's why in a lot of cases, like the closer you can bring that traction to the front, the better, right? We could almost argue at some point to be like, if you've already got revenue, just drop that, right? Start with that. Like, we've got a bunch of revenue. Let's tell you why. Here's the problem we solve. Now, of course, we don't do that because that's just not the pattern that people are used to seeing. But to some degree, right?
If you've got it, you got it. You can put it up front. But Ryan, challenge accepted. All right. So I like your answer saying, hey, maybe we shouldn't go out and raise. And I know that's going to be to the chagrin or disappointment of many founders. But let's just play this out as a thought leadership exercise for a moment.
Which is more disappointing, though. Hearing me say that right now, or going and trying to raise funds for the next 6 to 9 months and not achieving it. I will tell you right now, if you decide correctly that now's not the time to raise funds and you go out, you build the traction, you do the things you need to do, you will be a much happier person. You might not like the sound of it today, but I guarantee if it echoes back to you 9 months from now and you go, man, we didn't raise funds, we've been trying, it's not working, and it seems to be due to traction. I wish we'd listened to what they'd said back then. I don't want you to learn this in hindsight.
These are the truths that we wince when we deliver to founders because, again, they say, but I'm running out of runway, like I'm going to shut down. But Ryan, let's just play this exercise out.
Sure.
Point taken. I love how just straightforward. You're actually being a lot more blunt than I expected to be this time, but I appreciate it. So imagine a founder in this situation. Okay. So let's just take a B2C, kind of like this app. And because I know we like to get detailed about this and say, I don't have the money because investors want me to get traction, but I don't have the money to pay for traction or do a lot of the paid things. What would you do to go out there and at least get the flywheel going somewhat in this type of situation?
When you say the flywheel, are you saying how do we do a great job of substantiating our go-to-market slide, or how do we go out and get some basic traction?
Isn't that a combination of both, right?
Well, no, because one is sort of saying what I just said, which is like, well, then focus on some traction right now. Let's go. So I guess let's think about it 2 different ways. Let's say you continue with the fundraising, but now you realize that as you're out there, you're pitching or you're pre-pitch, you're still working on the deck. You're like, man, our go-to-market strategy is just a guess. Let's try to put some concrete behind it. I'd be looking for the smallest investments I could make in time, money, effort that would at least show that we've done some experimentation and there is some level of result, which you can scale. I say this to founders all the time. I don't need to see your 10-year projection. I can make up numbers too. Right? And I can do multiplication, which is all that is. We make 1,000 the first year, 10,000, 100 million in year 5. Great. Show me how $1 happened, right? Okay. Go show me what the effort was to acquire one user. Show me one. You don't have to tell me that's all you acquired. Don't, in fact, but show me here was the effort that was required to get a user. Here's why it's inefficient. Here's what we'll do in the future that'll be slightly different. And here's why that feeds into our go-to-market strategy. Show me unit economics of one acquisition, and then show me why we're projecting that out into go-to-market.
Okay, wait.
We tried this, and this. We were able to acquire users most easily, most inexpensively, and quickest here.
Okay.
And now we're going to parlay that into our go-to-market strategy.
But you said the word inefficient, Ryan. You're implying that investors do understand that it will be inefficient in the beginning. Just show them those unit economics. Yes. Tell that story.
Right. Look, you're always going to be doing your worst possible job at the early stage. Your product's going to be the worst it can be. Your team's going to be the worst it can be. Your customer acquisition cost is going to be as bad as it can be. It's all the worst it can possibly be because you're just getting started, right? It's going to be the least efficient. Now, there are some points where, like, yes, you'll hit that like early curve where, like, oh, paid spend is starting to work and we got really great numbers. But if we want to scale it beyond that, then it becomes less efficient. Yes, there are diminishing returns. Yes. It's not what I'm saying. At the beginning stages, our understanding, our budgets, our sophistication, all of that stuff is going to be the lowest it will ever be. Investors understand this. If not, they're not investing. They're investing specifically. Think about what an investor is doing. They're giving you money to improve something.
Yeah.
If there was no room for improvement, if there was no ability to buy down customer acquisition costs, there's no ability to grow your audience, they're not investing in your company. They're buying it. That's their only option at that point. If it's not going to grow, you can't invest. You can only buy.
Let me add one more thing here. Everyone, there is a difference between a growth investor, someone who comes in like at a series A, B, C, D, and an early stage investor, pre-seed and seed. They need to see traction, but they also accept the fact that you haven't figured it out, but you need to prove yourself as the founder who can do all those exercises and go out and fight tooth and nail to learn how to get traction. And if you can't demonstrate that, and if it doesn't come through in your go-to-market strategy, then why would an investor give you money to go figure out those things when they've got, let's say, 12, 24 other deals that already have traction?
This is one of those points that I wish we didn't have to make as often as we do. It's as if founders walk into a room and they assume that they're pitching to an investor who just has money allocated for exactly their deal and will just decide whether they get it or not. I have this piece of cake, and if you tell me the right story, I will give you the piece of cake. That's not how it works. They are deciding whether to invest in you based on how you stack up to every other option they have with their money, including just keeping it in cash because that feels safer or better.
Right.
So if you are a good-looking deal but don't have traction, somebody else has an equally good-looking deal and does have traction, guess where the check goes?
Right.
It's the same thing you would do with your own money.
It doesn't even have to be, like you said, the same industry. You could literally have someone selling soap, direct to consumer soap bars, like Dollar Soap Club, right? And you could be looking at a SaaS platform, and the investor is going to make a decision between the two. It's not like, oh, no, like you said, I'm earmarking for just SaaS platforms. Doesn't happen that way. So your competition gets compounded by all the different verticals and all the different problems out there.
Yeah. So I have a story that I've told a couple times in the podcast around like one of the early investors that I had, and they were entrepreneur, business person, but running like a very main street, just sort of run of the mill kind of business. He would tell you the same thing. Invest early on. And when I came back for a later round, the check size had grown a bit. The bite size was bigger. The business had gotten more complex and harder to understand. He was like, well, I could do that, or I could open another location for the business that I know generates me an 18% IRR, and I'm going to go do that. And I went, but it's now in hindsight, he would have been better off giving me the money. 4 years later, when the business sold, it would have been a significant multiple well beyond what he made, but he made the decision based on what he could see right then.
Right.
And he chose the traction of his 30-year career in this same line of business to open another location for what he already knew how to do versus invest in my startup. And this is the kind of thing that happens all the time. People are like, you know what? I'm just going to go put my money into an index fund. You know what? I'm going to buy another apartment building. You know what? Right. Lots of ways to spend investor money.
Let's go back to what you said before, doing the cheapest test possible. Like, let's figure out how a dollar works. Now, I want to do this exercise, and this is for everybody out there, not just this founder, not just for Didier. Ryan, let's go back and forth, because you're saying any founder, how I interpret it, can skip buying one coffee and put $1 to experiment something here, there, and show those unit economics. But let's go back and forth and talk about all the cheapest ways to go out and test traction, maybe get some customers, but at least have a semblance of being put together, having our stuff put together so we can put a go-to-market strategy out there. So let's bounce back and forth. Let's give ourselves like 2 minutes each tactic, and let's brainstorm, because I want to spread the mindset and open up the possibilities for our founders, especially especially in the audience, of what they could be looking at?
Instead of going specific tactic, I want to give people a strategy. Well, it's a tactic, I guess, but it's one that can span channels.
Perfect.
Right.
Beautiful.
And this is something that works really, really well. Whatever the channels you think you're going to go test are, let's say you've got one now that it's done $1. One of the things that I start to see founders do is, and they'll just continue spending in that channel, but at really low levels of spend, which is all you can afford to market. Okay. Fair.
Okay. Sure.
But if what we're trying to do is demonstrate traction and show why there is scalability in this channel, it does not do that. If you show me that you can spend $100 a day on Facebook and generate leads and generate a little bit of revenue, you've shown me that you can spend $100. I know that for a fact. What I don't know is what happens if you spend $1,000, right? You're telling me we're now going to go and we're going to take your money and we're going to plow a bunch of it into Facebook or whatever, insert whatever channel you want here. And this could be money, this could be effort, this could be time, this could be whatever the input to create scale in the channel is, right? So if it's content and you're telling me like we're producing one post a week or one post a month or whatever, and we're starting to see this growth, but with your money, we're going to 10x that instead of just continuing on that long, slow track. I like to do time or input compression. Money compression.
Okay.
So if I know I'm going to spend $1,000 over the month to show you that we can get this level of like, let's just say that buys us users let's just math simple here. It's $1 a user. He's somewhere near that in the deck. I think it's $1.50, but we'll just say it gets down to $1. $1 users. I'm going to spend $1,000 over a month's time, meaning I'm spending, $30 a day, and I can acquire 30 users a day. What you can do instead to show why your user acquisition can scale, compress all of that spend into 3 days.
Okay.
So now you show me that the ceiling that I'm going to be concerned about as an investor, right? If you know anything about digital marketing, you know that there are ceilings. They exist, right? Like there's times you can spend a certain amount of money and be efficient. The minute you get above a certain amount, you can't spend anymore. So whatever you can do to demonstrate the increased in activity that you're telling me you're going to do with my money,
got it,
and that it works, now you have my attention, right? So but you have to show this. It's not just about saying, oh, now we know we can. Tell me that you did this test. We were able to get users for $1 a piece. But in order to prove that what we want to do is triple or double, triple, quadruple, quintuple down on that bet, we compressed our spend. We ate up our entire monthly budget in 3 days, show ourselves there's no ceiling there and there is room to expand that budget. This is now why we are using this as our go-to-market strategy channel.
Got it. Time compression. I like that. That's a good factor. Let me throw one your way here. Speaking of paying for ads, spending money on ads, here's what I'll do. I will go and buy the same amount. I just recently did this. I bought $55 per ad. Each got me 280,000 impressions, and I could track conversions, like a whole bunch of different metrics. And what I did is I split test multiple rounds, and I have like 8 different types of styles of advertising, this and that, with different calls to action. And then I took all those metrics, and then the next round, I doubled down on the ones that worked well, and then I showed I could incrementally improve them. Now, here's the thing. I don't have $1,000. I think I spent $550 for 10 of these things, but at least now I can show the investor, hey, this is my thoughtful process of how I spent on ads, and I can show you that I understand how to maximize the conversion on my spend. I know for a fact because I've done this many times, showed investors, they appreciate that conversation.
100%. The key word there was show. I can show you that I know how, I understand how to improve this. With more money and more time, I can continue to improve this. If I tell you I'm going to improve this, what is that? One more point for scrutiny. It's just one more place for me to go, okay, why? How? You're going to get the questions. Whether or not you hear the questions is a different story. They may not even bother to ask you. They may just look at this and go, well, they've proven they can do this. They say they're going to do that. I don't have any faith they can connect those 2 points in a meaningful amount of time, and I don't want them to do that with my money because there isn't any proof point there. They haven't shown me they can do this. They've told me they're going to. Now, I might ask you a question. Okay, why did you choose this channel? What success have you had in scaling this? How much of a ceiling do you believe there is? When does this tap out? When does CAC start to exceed LTV?
Right.
All of these questions are in their heads. I guarantee it, whether you're hearing them aloud or not, right? Hopefully you hear them and you have an answer for them. Worst case scenario, they're just looking at it and going, they're not far enough along. There's not enough evidence here. They're not buttoned up enough, whatever. They're not showing me they're buttoned up enough. I'm not going to put my money here.
Let me bounce another one off you. I love this back and forth. Okay. Real simple way to start the initial traction. Here's how I've done it. I try to hack a community and I get metrics from social media. And then I show the investor how I can sort of game that or hack that to increase. Let me give you an example. One time I had to go, and this was just pure sales, but I worked on Muhammad Ali's social media. So for a period of time, I was Muhammad Ali on social media. Dirty little secret in the industry. But for a couple of years, if you got a like on social media from Muhammad Ali, that was me clicking that button. Now here's how
Were
I
you
got
also
the.
Tay Diggs? Because I remember when he followed me on Twitter, I was so excited until I realized he'd also followed 80,000 other accounts that same morning.
That's what happens. But here's how I got the job, Ryan. I went and I looked at their Facebook account and I studied all the analytics. And then I said, I think I can optimize one dimension. And I did a 1-day experiment. And then I showed the CEO of the Muhammad Ali organization, the Muhammad Ali Center. And he said, here, what are you doing? Come with me. We're going to pitch this to a sponsor. Or driving back, we got a phone call and they committed $150,000. And it was all because I studied the social media metrics and I did one small test and I could show the results based on my insight. And that's how I got the job. And, the rest is history. Ryan, that's what I'm saying. The principle is social media is free. Go try and hack a community, get the metrics, and as you said, functioning word, show the investor how you're managing the metrics to optimize for better outcomes every single step. What do you think?
It's exactly that, right? And it's clearly like you weren't trying to raise funds there, but it doesn't matter, right? The principle is exactly the same. Go and show an ability to navigate a situation and create the desired outcome. If you say the desired outcome is we need 10,000 users, but you can't show me that you know how to get to 100, I have to just take that on faith, right? I can tell you, my pen comes out of my pocket a lot less often as an investor for faith than it does for proof. Like, I don't want to just believe you can do something. I want to know that you've done it, at least some version of it, right? So getting out there. So using social media, again, like I don't care what the channel or the tactic specifically is.
Right.
I want you to think about it in sequence. I want you to think about how we picked it and why, how we tested it, what the result was, what was the learning from that, what did we do next based on that. The more of those links in the chain you can show, the stronger your traction and go-to-market is. If you just show, we went and paid some money, we got some users, cool. Was there a step 2, 3, and 4? Did you do anything else? The more steps you can chain together, the more powerful this story becomes, right? And I think that's somewhere that we miss. We just go like, okay, I'll go get some initial traction, and then I'll just use that. Tell as much of a story within that as you can that takes you from traction to go to market to scale, right? Those 3 things have to tie together. I'm going to scrutinize them, right? When you get to your 10-year projections, I'm going to go, but that doesn't tie back to, or you haven't shown me enough to make me believe that from the initial traction that we have now to what you're saying from go to market to where you're telling me you're going to be in 5 years have anything to do with each other, right? The thread through that story becomes a lot stronger when you chain together a couple of actions that show, here's how we reacted. Here was the next result. Here's how we reacted. Here was the next result. This is the story I want to see when I'm looking at your traction, your go-to-market.
Founders, I cannot tell you how valuable this information is, and I hope it doesn't fall on deaf ears. Ryan, I'm going to give you one last part to comment on. You got 2 minutes to comment on it.
All right, let's go.
Founder-led sales. When in doubt, pick up the phone or whatever and start texting people. But my question to you is, how can we translate founder-led sales to our go-to-market strategy and share that story on that slide in our pitch deck?
I mean, like you talk about actual interactions, right? Again, tell the story. Like the first couple clients that I reached out to, like we didn't understand how to navigate that process, right? Our close rate was this, our take rate was that. We were getting rejected left and right. Then we learned based on what they were telling us. It's all about that process of evolution.
Right.
Because if you show me that you can evolve that, then when you tell me we're going to do something else, we're going to evolve that to that, I have a little bit of faith at that point that you can do that. You've demonstrated an ability to evolve a process. Founder-led sales, absolutely, right? Because it's often the least expensive way we can just get started. Now, if we want to get into time cost, all that, is it efficient? No, not necessarily. But you know my feelings on efficiency. I don't care how efficient it is if it's not effective. So if it's effective to begin with, again, go back to it. Show me you knew how to sell one person, right? Even if this is a scaled digital product like football money, would it make any sense to do long-term founder-led sales for a product that's going to make you a couple dollars per user per month? No, of course not.
Right.
But it makes all the sense in the world if you say, so what I did was just start going into forums, talking directly to fantasy football users, and I convinced them to come and use my app. Here's what I learned in that process.
Yes.
Here's why they said no again and again and again. Here's what I changed to get them to say yes again and again and again. Here's how I am going to scale that effort based on what I learned doing founder-led sales into a digital-first acquisition plan, right? I'm not guessing what it takes. I'm not iterating ads until I find out which one works. I'm taking the very language that I used in one-on-one conversation to convince somebody to use my product, and now I will scale that.
Everyone, based on what Ryan said, you really don't have an excuse because everyone can do founder-led sales. I understand the allure of wanting to go out and quote scale. Founder-led sales is part of the whole package. Do things that don't scale. We hear that from Y Combinator all the time. All right, I'm going to end with this. I'll give you the last word to see us off. Everyone, this is not easy. If it was easy, all of you would be funded. I'd be a billionaire, right? This is not easy. Development has gotten easier. I would say distribution has gotten harder. So if you're sitting there gnashing your teeth, sweating, like it's a total sweat, just thinking about this and going through it, it's okay. You're in good company. We understand. It's hard, want to acknowledge that, but that's why we're here and want to encourage you to persevere, be relentless, and move through it. Ryan, what's your last word of encouragement for everybody ending this off?
If there is anything that will increase your likelihood of getting funding, it is traction. It is traction. And if there's anything that will improve your go-to-market slide, it is traction. If there's anything that will improve your traction slide, it's actual traction, right? Get out there and let rubber meet road. And just make it also like, maybe this is just me, but nothing feels better than making that type of progress in the actual market, right? It is so motivational. Getting out there and knowing that people actually want this thing that you're going to go do, kind of important no matter what. To some of the points we made earlier in the presentation or in our discussion today, Ed, traction can trump all. If I don't believe in your problem and your solution or your financial projections, but you show me that it's working now already, I have to shut up. I have to at that point. I'd be like, I don't think your problem is. I don't think people will pay for that. And be like, they already are. Okay. Now, there's lots of other questions that'll have to be answered at some point around how does this scale? What can we do in the future? How does this become better? But if we start with traction, we start with a huge head start.
Everyone, we're going to come out with the t-shirt, Traction Trumps All, with a little quotation for Ryan Rattan. You heard it here. Ryan, always a pleasure. We're going to do this
Super
again
fun,
next week. And everyone, keep your decks incoming. Share with us your go-to-market strategy. We're here to help. Thanks again, Ryan. I'll see you in a week. Thanks, everyone.
Cheers, guys.